we're just talking about just these tensions and the conflict clearly that investors are feeling at the moment. What's the best way to balance your portfolio to kind of find some of these risk opportunities given just the breadth of uncertainty that's out there?
So Heidi, that's a topical and great question. It's really what all the investors we're talking about or talking with are concerned by. Just to back up, I think the key challenges that investors are facing, and it started at the beginning of this year, which is slowing growth and rising rates. We've got this term we call the metaphorical growth rate jaws. And when those are closing with growth slowing and inflation, and rates rising, that's typically not a good environment for equities, and contrast when the jaws are opening, which is when growth is rising and rates are falling. And then on top of that, we've had this supply side shock in terms of oil following the geopolitical events and the invasion of Ukraine, and that's added or intensified a so-called stagflationary shock, where growth has come down and inflation has risen, and that's led to further hawkish expectations in terms of monetary policy. So it's a challenging cocktail of factors. The punchline for us is that we think that, number one, the region as a whole has traded a lot of that. We think valuations are attractive, but of course valuations never make the top or bottom of markets. More specifically, we think that parts of the markets still do look very attractive. Those would include banks, which benefit, of course, from the tightening monetary policy environment, and very much the commodity cyclicals and energy, which benefit from the very strong commodity pricing background. Those would at least be two ideas of areas that we think are not fully represented in many investors' portfolios and have fundamental backing behind them.
Perhaps none other, than China when you talk about some of these valuations, right? Is that attractive now? It feels a little bit like authorities are running out of ways to try and stoke confidence for investors, particularly foreign investors. But does this new spending on infrastructure, construction, to try and get that GDP target somewhere close, give you that confidence?
Well, we certainly are optimistic that a policy can come through and support the economy in due course. I think the challenge here for China specifically is a sequencing one, whereby the zero COVID or the COVID situation really needs to be dealt with to a greater degree before full-fledged infrastructure investment can really take hold. I mean, just to sort of be very specific about it, if an entire city is locked down, it's very hard to do a lot of infrastructure spending there until you ameliorate that near-term problem. So if we look further out into the year, we think that there will be a moderation of the COVID intensity. That's obviously very difficult to forecast the timing and the magnitude of that, but that's not a completely foolish expectation. And there certainly are plenty of policy tools that China intends to implement. Most forcefully, we think, will be in spending on fixed asset investments, specifically infrastructure. And if we combine that with the fact that the market's traded down very, very aggressively, just one data point is that the MSCI China index, as of yesterday, was trading at 9.4 times 12-month forward earnings. So even if we allow for some further earnings downgrades, which we think will take place, you're still talking about a market that's trading under 10 times forward earnings. That's about half of where it was trading a year and a half ago. So we think the conditions are there for some upside recovery, but we really need to get through this near-term challenge in terms of the immediate shock to growth in the second quarter before investors can feel some confidence about re-engaging.
And of course, we have more than 500 Chinese companies reporting earnings this week. What are you watching? This function on the Bloomberg actually showing us that so far it seems sales and profit have been to the upside. But are you at all focused on any areas that investors should be watching?
Oh, absolutely. So this is the prime week, the top week for earnings for China and for the region more broadly. And then the next 3 weeks of May will be also the bulk of the reporting season. And after those 4 weeks, we'll have pretty much a full view in terms of what's taking place. So far, at least as of 2 days ago, we just ran the numbers most recently. About 9% of China's stocks have reported, and the year-on-year growth in earnings was 23%. Which of course looks good, but that's still a very, very small sample set, and it could be, because we're biased by which companies have been reporting. So I don't think we should read too much into that. Additionally, I think that a lot of investors will not be looking so much at the numbers that are reported in first quarter. They'll really be looking more forward in terms of what the guidance from companies will be in the second quarter, because of course that's when this shock to the economy has really happened. First quarter GDP, as we know, was 4.8%. It was above expectations, but second quarter is going to take a hit. And so I think people really will be looking much more on a forward basis in terms of how much of an impact will be to earnings in order to gauge their views on what to do with the stocks.
Let me just start with what's happening in Japan, because the yen continues to weaken. The BOJ continues to buy bonds at this point. What are we expecting? Will they have a problem with the collapse of the yen when they come out with a decision tomorrow?
So the bottom line is we think that it's going to be status quo in terms of the BOJ decision. Our chief economist in Japan, Baba-san, just recently published a note on this. And I think that the logic is very clear, that there's not too much that the BOJ, we think, can do given its objective of supporting growth and trying to make sure that inflation comes back to its targets. I mean, the reason, of course, why the yen has been so weak is that the interest rate differentials with the United States have been widening given the increasingly hawkish statements coming out of the Fed and the market pricing that in. So the near-term differentials between U.S. rates and Japanese rates have widened. And that's obviously propagating broader-based dollar strength, but in particular, yen weakness. There's not really too much that can be done. Our expectation is that the BOJ just really needs to wait for yields to stabilize, U.S. yields to stabilize, and that in turn should probably stabilize the yen, which we think is overshot to the upside in terms of JPY level. But it's hard to argue for a meaningful rally in the yen until we see some stabilization in that rate differential.
Tim, talk to me about the capital-centric strategies that you're looking at and which markets you're looking to best apply that to.
We've had a couple of I guess changes in our views over the course of the past few months. I'd say the most significant one is, for the first time in 10 years, taking a more constructive view on ASEAN. I mean, ASEAN had really been the sort of the poor relation in Asia for, as I said, really a decade, because all attention was really on, particularly on China, and within China on the new economy, the digital economy theme that was so strong and which created so much wealth. And ASEAN, I think, in that environment was a laggard because ASEAN indices tend to be very overweight in financials. And liquidity was low, and just the whole center of attention was elsewhere. Now I think that's changing. Number one, you've got a recovery more cyclically from COVID lows. So you've got actually some accelerating GDP and earnings growth in many parts of ASEAN, which is in stark contrast to many other parts of the world. Number two, with the rate cycle changing, the heavy index weighting in financials is to ASEAN's benefit, particularly for places like Indonesia and Singapore, which we upgraded about 4 months ago, and happily so. And then thirdly, you're seeing the emergence of the digital economy coming into some of the ASEAN markets, notably again in Indonesia and Singapore. And all that's pretty attractive. So they are the outperformers this year, and we're quite pleased with that.